Hey, what's up? Welcome to DGen That's degenerative education, meaning none of this is financial advice. Just me having fun looking at charts like the chart behind me, which is of NIO, ticker symbol NIO. And so here I am recording this on Saturday, June 1st, after NIO closed the month of May at a price of $5.39, being down about 0.2% on the day, but then coming up a few pennies in the after hours, closing the after hours session for the month of May at a price of $5.43. And so I wanted to go over the chart for one big reason, and that is because they are reporting earnings next week, June 6th at 8 a.m. Eastern. I'll be hosting it here on the channel, so if you do want to listen in, it'd be great to watch the chart as they do report those earnings. But just looking at the chart, I've gone over this in prior videos, talking about how I do believe that we have put in an inverse head and shoulders pattern. I thought this might be the right shoulder here, but it does look like, that was kind of a fake out. And I do think we have just recently put in the top of that right shoulder, or really the valley of that shoulder, since it is an inverse head and shoulders. And with that, I do think that we could be seeing price going a lot higher. So like I've done in prior videos, if I do take a measurement from the top of the head here up to the neckline drawn by that purple line, that represents about a $2.50 move to the upside. And if I do move that to the purple line, about where that break would be, that would be bringing price up about $2.50 from right around $6 a share. And so that would be bringing price up to right around $8.50, maybe $8, maybe $9, maybe just getting up to $7 a share, marked by that yellow line. But I do think there is a lot of upside potential for NIO. And I think the one thing that NIO has been struggling with is just not having enough momentum, not having enough volume to break above $6 a share. So we see that marked by this orange line here. There was a lot of consolidation over here at the beginning of the year in January, consolidating right around $6 a share, getting multiple attempts to break above that level, getting up to a high of $6.30 on March 12th, but then ultimately getting rejected below $6 a share, even getting below $5 a share, hitting a low of $3.61 on April 22nd, and then coming back up to test $6 a share, forming a double top here with this massive bearish engulfing candle. And so, $6 has been a level that NIO has been contending with for many months so far this year, and it just hasn't been able to get a break above it. And so here on, May 6th, we got a high of $6.04, but just a wick above that level and closing on that day at a price of $5.69. So not able to hold $6 a share. And then when we put in this bearish engulfing candle, we hit a high of $6.05. Bearish engulfing candle closing at $5.33. So just massive signs that that level is important, that we really need a lot of momentum to be breaking above it. And so I view that this earnings call could be that momentum to get the stock to be trading above $6 a share. And so there are multiple reasons for that. And I view whenever there are multiple things stacked up, whether bullish or bearish, the stock is more likely to move in that direction. And so just like with SoFi, I predicted that price would go down following earnings because there was a bear flag, because there was a lot of consolidation or a head and shoulders pattern that suggested price would be going lower. I see the exact opposite with NIO. I see an inverse head and shoulders pattern here, and also I see a bull flag that we formed from the low, hit on April 22nd, low of $3.61, price moving up to $6.05 here, consolidating above this downtrending level of support, which if I do go back in time, we can see where that originates from, going back to the low of October 24th, 2022, and then also the low of June 1st, 2023, so a year ago as I record this, those two pivot points, that pivot low being at $7 a share, we have been respecting that white downtrend as support other than this break when we started to form the head for that inverse head and shoulders. Also, it does look like we have respected $4.78, this red line, which was the low hit on March 5th. That being $4.78. We did get a couple wicks below it, but we have not seen any closes below it in this little rebound from $6 that we've seen. We have bounced, and this does look like it could be taking us higher than $6 a share. Whether we consolidate over the next few days around current price, around $5.39, I think that this earnings could be launching us above 6, above this neckline, bringing us towards that $8.50 target. Maybe it only gets to 8, maybe it goes as far as 9, or maybe it does stop out around 7, as that does seem like there will be a lot of resistance there with this consolidation just above that level. We could be stopping there, but maybe we could be getting up to filling this gap, and with that low of that day being $8.95. So I could see price getting up there, maybe not right after earnings, maybe we do get rejected at 7 following earnings and then pull back to test 6 as support before continuing higher to $8 or $9 a share. And then another reason why I do think this looks really good is if from this retracement that I've done from the low of 361 up to the high that was actually hit on May 15th of $6.05, being 1 penny above the high that was hit on May 6th, but actually 605, and you can see that here that I have that range from 361 to 605. And from that retracement, we can see the 50% level was $4.82.8. We have respected that. We have gotten what looks like some closes right around that level, some below it. But more or less, we have respected that level before bouncing, not only respecting 478, not only respecting this downtrend, but also the 50% retracement. And so I just think the chart looks like it is primed for a massive move following earnings to above $6 a share. I think that we're finally going to break above that level. And so one thing that I've been thinking about recently is that thinking about call options and not buying out of the money call options because those are more likely to expire worthless, but thinking about buying in the money call options because I do think that NEO is set up at a pretty interesting price to potentially be making some money on some calls. And so in order to first look over at the options, I'm going to first look over at the max pain. And so I'm going to do that from this website here, maximum-pain.com. And so we can see that the max pain for this coming Friday, so that is the Friday right after earnings, the max pain is $5 a share. And then the following week, closing on May 14th, $5 a share again. But then the week after that, so this is the monthly contracts that expire in June on the 21st, max pain is $5.50. And so if we do look over at current price, it is between $5 and $5.50. Like I'm saying, I think price could be going above 6. And so I just want to explore some call options that expire over the course of the next few weeks, ranging from about $5 a share up to $6 a share to see if there might be some good options for either swinging the calls to make money on the premium or to establish a larger position, because buying a call option is basically like putting up front some money to get the exposure of having 100 shares. And so if you were to buy 100 shares of NEO right now, that would cost $539, but you can get exposure to 100 shares by just buying a call option, paying that premium for the contract. And so you're paying less money to get that exposure, but there is more risk. And so I'm just gonna flip over to the options table so we can look at some of the calls that are expiring in the next few weeks. So here, looking over at the table, we have contracts that expire June 7th, June 14th, as well as June 21st. And with these, we can see the ask price. So this is how much it would cost to buy a call option. And the strike price is what the price needs to close above for you to be able to exercise the call option. So I had previously been thinking about calls or buying options as if I buy it out of the money, I can get exposure to 100 shares with putting less money up front, but not wanting to exercise it. And so with NEO, with the max pain being at $5 for the next couple weeks and then $5.50, I view the $5 strike as being pretty intriguing, whether that's for this coming Friday, the Friday after, or the Friday after that. And so I just wanted to explore some of these options and also consider the open interest. So that's the number of contracts that are open currently with exposure to NEO with these strike prices. And so there are a few things that stand out to me. And so one is that with NEO having earnings on this coming Thursday, basically any of these call options that expire the day after, that's kind of like gambling. It's pretty risky. But what I can see with this is that there's a good amount of open interest, 14 to almost 17,000 contracts. So there's a good amount of interest ranging from a strike of $5 a share up to $6 a share, with price currently being above $5. The only one that's in the money is $5 a share. So that seems least risky, but if we look at how much the cost of it is, that's about $59 because it's 59 cents times 100. That is, in my view, more intriguing than these that are cheaper at $33 or $18 because they're out of the money. It's risky. And if NEO does close above any of these prices on Friday, those contracts could be then exercised. And so I'm asking myself, do I want to get 100 more shares at $6, or would I rather get 100 more shares at $5 a share? And so for me personally, I'd rather buy 100 shares at $5 a share, but pay a premium of $59. That would put my total cost at $559, so about $20 more than what I'd get if I just bought shares right now. But I only have to pay $59 up front. Whereas if I were to do the $18 contract with a strike of $6, that could go to zero if price is below $6. If it's $5.99 at close on Friday the 7th, that contract would be worthless. That $18 would not be worth anything. So I find all of these really to be pretty risky, and I would rather have exposure to 100 shares that I could carry out for the week of volatility following earnings if there is some volatility to the upside. So I view, for the most part, all of these as being pretty risky, but maybe not right now, because over the next couple of days, the premium for these contracts will go down. That is theta decay right here. That price for these contracts will be going down over the course of time leading up to expiration, which is June 7th. And so I view the only one up here for this coming Friday of interest as a gamble is really like the one with a $6 strike, maybe getting a contract Wednesday before earnings. Maybe it's $10 per contract. Get one of those, and that would give exposure to 100 shares at a cost of $10, risking $10. And if price goes down following earnings, that contract would likely end up being worthless. But if price goes up following earnings, which would then allow for trading on Thursday and Friday, maybe that $10 could maybe double and go up to $20, something like that. So very risky with the June 7th expiration. But, I do think that is of interest, especially with these contracts that do have higher open interest. And then looking down on the table at June 14th, I feel like this is a safer bet versus the ones that expire just after earnings. And the one that stands out to me here on June 14th is with the $5 strike. That would cost $66 per contract. So it's a little bit more money up front than the one expiring the week before. Then there's another week to be able to capitalize on volatility, to exit the position, to swing that contract if price does go above $6 a share, or maybe to exercise it on the 14th and then buy 100 shares at a price of $5, as long as the closing price on that Friday is above $5 a share. And so I find this one to be pretty intriguing. $5 a share seems safe, and I would also be happy to exercise that contract, paying $66 in addition to buying 100 shares at $5 per share. So that is of interest. But then another one that's potentially, less risky than the one expiring the day after earnings with the $6 strike, that is $24, giving an extra week expiring on the 14th. So that is of interest as well. But what I'm trying to get better at is establishing call positions going long in the money, because then I can just hold those contracts for weeks and not have to get in and out so quickly. And looking at the June 21st expiration for the $5 strike, a contract is about $70. So that's one contract. Exposure to 100 shares, 100 times 70 cents is $70. And so that to me makes me think, I'd be happy buying 100 shares at a price of $5.70 because I think price is going to go above $6. And so I'd be risking $70 with the possibility of buying 100 shares, exercising at $5 per share. And so if it does expire above $5 a share on June 21st, those contracts would potentially be worth a lot more than $70 per contract. And with max pain for that Friday being $5.50, I feel like it's fairly likely that price will be going up. Price will be above not only $5, but above $5.50 on that expiration date. Or if not, there are 3 weeks between now and that expiration to be able to swing this position. If price goes up to $7 a share and this strike is $5, that's basically turning this 70 into around 200. And so that's a pretty nice swing. And so I'm intrigued by all of those. I have not established any call positions with NEO right now, but I do plan on doing that before earnings, probably buying 1 to maybe 3 contracts, because I feel pretty convinced, I feel pretty confident that price will be going higher, will be breaking above $6 a share following earnings. And I think that this is just going to be the beginning of a lot of upside, getting towards the top of this downtrend that we see here, filling these gaps up to $9, $10 a share, potentially breaking out of this wedge. Maybe, testing the levels here, $16 a share later this year. So I just feel really, really bullish about NEO. And I do think that a nice way to get exposure to more shares without having to put down a lot of money right away is with call options. And I think, while it's gambling around earnings to be holding contracts, I think that the chart looks really, really nice. And so I'm excited about it, and I don't want to convince anybody to do anything else, but just looking at the chart, to me, it looks beautiful. It looks very clear what is going to happen. And so just to kind of exercise my conviction, I am really excited to see what happens with NEO following earnings. I think we'll be closing next week above $6 a share, but I'm probably not going to bet on it. Or if I do, I would bet at most $20 because I would expect that to possibly go to zero. But for the longer dated contracts that end the date of June 14th or 21st, I think with a strike of $5 a share, I'd be happy to pick up more shares at $5, even if there's a premium. And, I'm just really excited about the chart. I hope you are too. But, those are just my thoughts. If you found them helpful, make sure you like the video, share your thoughts in the comments down below, and subscribe to the channel for more videos like this. Thanks a lot for watching. Take care.